Ladies and gentlemen, welcome and Happy New Year. Thank you for joining our Q1 2019 investor call. I'm Richard Lightbound, the CEO at ROBO Global for Europe, Middle East and Asia. In terms of agenda, we will be giving you a quick update on our recent 5-year anniversary, then provide some context to our Q4 performance. Thirdly, we'll run through index member changes from the Q4 rebalance. And finally, we'll share with you our 2019 insights for robotics, automation, and artificial intelligence. At the ROBO Global website, you can download our 2019 Outlook report and the Q4 earnings report. Or if you want to make life easy, please register for our bi-weekly updates where all Robo content is distributed. All details of this are on the final slide. On the call today, you're going to be hearing from myself, so again, Richard Lightbound in London, as well as Jeremy Capron, our Head of Research, and Lisa Chai, our Senior Research Analyst. Both Jeremy and Lisa are joining us from New York today. So 5 years ago, we started ROBO Global to do one thing, which was to provide investors with exposure to best-in-class companies across the entire value chain of robotics, automation, and artificial intelligence. Last year, we were thrilled to celebrate our 5-year anniversary and assembled in New York the ROBO Global team, as well as 5 of our highly distinguished advisory board members who flew in from Japan, Switzerland, and the US. It was a very client-orientated event with presentations and panel discussions where our advisors shared their unique insights and experiences as world-leading robotics and AI experts. We probably had a couple hundred clients in attendance and managed to squeeze the entire group onto the floor of the New York Stock Exchange as we rang the closing bell. And it was an absolutely fantastic day and milestone for the ROBO Global team. Now, we're starting to get asked what's changed over the past 5 years. So let me just share a few thoughts with you. Firstly, nothing has changed in terms of our focus and conviction. So we continue to research and provide exposure to best-in-class robotics and AI companies. And our conviction has never been higher that this is an investment opportunity you cannot afford not to be allocating into. I think what has changed is the team. We've seen especially our in-house research group grow, as well as the advisory board. We now have 7 PhDs on the advisory board from the world of robotics and AI. And this is a group that helps us to look forward and shape our strategies. The most recent addition here is Professor Daniela Roos, who is based at MIT and director of the Computer Science and AI Laboratory. And like all of our advisors, it's an absolute privilege to have access to senior experts like this, and a big part of what makes ROBO so unique. In terms of our research, we continue to very much look forward, identifying new and core technologies and product areas, and Jeremy and Lisa are going to be sharing some of that with you. This work is very much constant for us. It involves us traveling the globe, working with advisors, meeting companies. And as a result, the index has evolved very gently over time. We have a quarterly rebalance where company additions and deletions are made. Tend to see 2 to 3 changes per quarter. Right now, there's 88 companies across 14 markets and our 12 subsectors. The index, as we just said, has been live for over 5 years. It's expanded into an index series. It continues to employ research and quality filters. And most recently, we introduced an ESG filter. I think on the product side, it's been very interesting for us because now across all of our partners who license the index, there's well over 2.5 billion of AUM. And just finally, I think it's worth mentioning that since we started ROBO Global, we've probably seen about 30 other robotics and AI type strategies come to market. And from our analysis, we can't find anyone with more than a 35% overlap to the ROBO members, which tells you that these new strategies struggle to define what is a robotics and AI company, what subsectors should be focused on, and how best to identify appropriate companies. So with that, I'm going to say thank you and hand over to Jeremy to talk about Q4.
Thank you, Richard. So the final quarter of 2018, global equities suffered their worst quarterly decline since the financial crisis hit in 2008, and the ROBO index was no exception. It dropped nearly 22% in the fourth quarter of 2018, which was the largest decline since the inception of the index more than 5 years ago. And looking at a backtest, a decline of this magnitude only happened 3 times in the past 15 years. That was in 2008, in 2011, and most recently in 2018. Now, this 22% decline is about double that of the World Equity Index, which is shown here on the chart on the right-hand side. However, I think it's really important to put this in the perspective of the tremendous returns delivered by the index in recent years, most notably a total 72% in 2016 and 17. And this chart and the table show the significant outperformance against the World Equity Index over the past 10 years as of January 15th. And on the next slide, I'd like to talk about some of the important dynamics that we saw play out in 2018. And the first point here is that you can see the significant dispersion in terms of returns by subsector and the benefits of diversification, which is a key characteristic of the ROBO index. The best performing sector was healthcare, which was up 15%. Think about surgical robotics, lab automation, DNA sequencing, where a lot of structural growth is coming out. And the worst performing sectors were all related to factory automation, with declines of more than 30% in manufacturing and industrial automation, as well as actuation, which includes the makers of key components and physical parts of robots. And this really reflects the main headwind of 2018, which has been slowing capital investments in the industrial world, and particularly in Europe and China. In China, where buyers of automation equipment delayed their purchases in the face of rising uncertainty around trade with the U.S. And the trade war really compounded the down cycle that we saw in industrials. And you can see that in the table on the right-hand side. Returns by country show a very similar picture, with industrial and engineering specialists in Japan, in Germany, in Switzerland at the bottom of the rankings. Now, we are more than 12 months into this industrial down cycle. Those down cycles typically last 18 to 24 months. And our global CapEx indicators are back in the bottoming territory. So I think it's an interesting time to start looking for an inflection. And I'd like to use the next slide to illustrate a few points regarding fundamentals for the index. And first is valuations. And as you can see on this price earnings chart, on the right-hand side, this is a forward PE chart. The index closed 2018 at valuations unseen since its inception in 2013. Forward PE of 17 times. That is more than 20% discount to the 5-year average of 22 times. And it's a nearly 10 points decline from the highs that were reached in the summer of 2017, when we saw this synchronized recovery in manufacturing activity around the world that propelled some of the factory automation stocks to new highs. So in terms of earnings, we're probably going to close 2018 with another year of double-digit EPS growth, probably around 18%. In 2017, we saw more than 20% EPS growth. And right now for 2019, we are looking at around 10%. a little over 10% growth. So certainly a slowing earnings growth trend, but still very respectable, and I think that puts the divisions in the spotlight here. So what to expect in 2019? I think we'll see EPS growth start to accelerate in the second half as industrial and factory automation markets bottom out, and structural growth continues across some of the key sectors represented in the index. And importantly, I think we'll continue to see an acceleration in M&A activity. We've seen an acceleration in M&A activity in robotics, automation, and AI in the last few years. In fact, 9 ROBO index members have been acquired since the inception of the index in 2013, and another 4 were targets of failed takeover attempts. And most recently, Mazor Robotics, the surgical robotics provider, was acquired by Medtronic. Just quickly on the next slide, I'd like to talk about some of the key subsectors of the index where we expect structural growth to continue in 2019. I touched on factory automation and manufacturing, where the cycle plays an important part, and we're probably closer to a bottom than to a peak at this point. It's really interesting to see the next generation industrial robots, so-called collaborative robots, that can work safely alongside human operators, a market that's growing at more than 50% per year. In logistics, e-commerce is driving a significant increase in the intensity of automation in warehouses and distribution centers. We think that story continues to play strongly in 2019. Logistics has been one of the best performing subsectors of the index since inception. And healthcare, which my colleague Lisa is going to talk more about shortly, where we continue to see new surgical robotic platforms come to market. And in the last couple of years, we've seen a real explosion in terms of the whole DNA sequencing movement that's driving purchases of lab automation equipment in particular. The last point I'll make is regarding the changes to the index in the quarter. We had 3 additions. The first one is biotelemetry in the healthcare sector. That is the leader in cardiac monitoring. They have a really interesting mobile wireless solution that's been used in collaboration with Apple to drive the largest ever clinical study around heart issues. And Globus Medical is a provider of a spine surgical surgery solution, robotic surgery solution. And finally, Materialize, which is a company built in Belgium that is the leading provider of 3D printing software and very innovative in the medical space as well. So with that, I'll pass it on to Lisa.
Thank you, Jeremy. A key highlight from the 2019 trend report that we just published is the massive transformation that the healthcare sector is currently undergoing. Aging demographics, pent-up demand, and new medical advancements are fueling rapid growth in the space. Even in the developed countries where the high cost of healthcare remains a hot issue, people are becoming a lot more conscious about their health and more willing to invest in maintaining it. These disruptive forces in the sector are driven by primarily robotics, automation, and AI. Today, the healthcare industry accounts for 10% of the ROBO index, with a strong focus in robotic-assisted surgery, laboratory automation, genetic sequencing, molecular diagnostics, and AI-powered healthcare applications. The healthcare sector returned more than 21% in the first 11 months of 2018 and has been the best performing sector since the inception of the fund. As surgical robots continue to gain traction, we believe that M&A in the space will accelerate. In robotic-assisted surgery, our index member, Intuitive Surgical, continues to dominate with an installed base of more than 4,500 Da Vinci systems and has helped perform over 3 million minimally invasive surgery worldwide. Shares were up 28% in 2018, and we expect continued momentum as a range of applications expands from urology and gynecology and into general surgery in 2019. More importantly, we expect surgical robots to continue to gain traction in orthopedics, as Jeremy mentioned, as seen with one of our previous index members, spinal robotics pioneer Mazor, which agreed to be acquired by Medtronic in 2018 for over $1.6 billion. We expect additional M&A activities in the space this year. One of our newest index member, Globus Medical, is the second largest player in the spinal surgical market, who is poised to take market share with its complete suite of spinal products. Globus maintains an industry-leading EBITDA margins of 35%, while introducing innovative solutions for the spinal and the trauma procedures. Other growth prospects include international expansion, as just over 10% of revenues generate overseas currently. The company also recently pre-announced positive sales results for fourth quarter and increased its outlook for fiscal year 2019. Its emerging technology business that includes robot-assisted platform demonstrated an impressive 35% growth during the quarter. DNA sequencing leader Illumina, one of our other index members, delivered its 20th year of sequential revenue growth in 2018. We believe Illumina will continue its sales and earnings momentum in 2019 with the strength of the product portfolio and expanding market opportunities. Illumina's recent acquisition of Pacific Biosciences gives the company access to native long-read technology to enable new insights and additional breakthroughs in medical science. As advances in genotyping and gene sequencing becomes widely available, with the help from Illumina, we believe the world will be gathering massive data sets supported by big data infrastructure to leverage all of this data to radically improve the prevention and treatment of diseases.
Okay, so on behalf of Jeremy, Lisa, and myself, thank you very much for joining us. I hope this was informative. We really would encourage you to sign up for our bi-weekly newsletter. We use that medium to distribute all of our content. Questions are always welcome as well. You can contact any of us directly, or you can use the info@roboglobal.com email address here. Thank you very much.